It's 9:48 on a Thursday and your thumb is hovering over a button. The cart says $130. The button says 4 payments of $32.50, $0 due today. You tap it and the order confirms before you've finished deciding whether you could actually afford it. For years, a tap like that vanished. The second the screen went dark, no bank knew, no lender saw, nothing got written down. This is the first one that doesn't disappear. Alex just tapped the same button on a phone attached to a credit history that's still a blank page. About to get its first line written by a $130 purchase nobody used to be able to see. Here's the part of most people never clock until it's too late. Pay in 4 didn't feel free because it was interest-free. It felt free because it was invisible. And the invisibility is over. $0 due today might be the 4 most expensive free words on the internet, because that zero just stopped being a secret between you and your checkout screen and started being a line on the permanent record that decides whether you get a car, an apartment, or a halfway decent interest rate. At Mr. Sense, we spend way too much time reading the fine print these apps are betting you'll skip. So if you've ever tapped Pay in 4 and forgotten the loan existed by dinner, subscribe. We break down one money trap every day, so you see the next one coming before it sees you. The industry already has a name for this kind of money. They call it phantom debt, borrowing that doesn't show up where lenders look, so on paper you don't owe it, even while you're paying it off every 2 weeks. For most of Pay in 4's life, that's exactly what it was. A ghost. Take the purchase Alex just made and rewind it 18 months. Same $130, same 4 payments. Back then it left no trace. The bureaus didn't know what happened, and when Alex applied for anything, it was as if the loan never existed. Now run the same tap today. Affirm, one of the biggest of these apps used by 45% of everyone who's ever tried buy now, pay later, call it nearly half the line, started handing every one of its pay over time loans to the credit bureau Experian for anything opened from April 2025 on, and to TransUnion a month later. 2 of the 3 big bureaus. The ghost just started leaving footprints, and a lot of people are in that line. More than 50 million Americans took out at least one of these loans in a single year. That's not a fringe corner of the internet. That's roughly 1 in 6 adults. Here's the number that should stop you, and it's actually 2 numbers that happen to be the same. Nearly half of all Americans, 47%, have used one of these services. And of the people who use them, 47% paid late in the past year. Same number, twice. Say it out loud. It's not a careless minority who fumble Pay in 4. It's a coin flip. Every other person tapping that button missed a payment last year, and that number is climbing. It was 34% just 2 years ago. It gets worse when you see how people actually use them. 63% of buy now, pay later users have juggled more than one loan at the same time. A quarter of them, 25%, have run 3 or more at once. Picture 4 separate apps, each with its own due date, each set to auto-debit your checking account on its own schedule. That's not a budget. That's a Jenga tower of due dates. And every pull lands on the same account. Bella, you might know the type, the one whose feed looks like she's doing great, has 5 of them going right now to keep the look running. Hold on to Bella's 5. We're going to add them up in a minute. Now here's where the story gets genuinely tricky, and where most of the panic online gets it wrong. These loans are landing on your credit file, but they are not yet pulling down the credit score lenders actually use. Right now, they sit on your report tagged and set aside, visible to the bureaus, fenced off from the math. FICO did build a brand new score to fold them in. They announced it on June 23rd, 2025, the first credit score ever to count buy now, pay later. But the fine print version reads differently than the headline. That score is barely switched on. It only works once the bureaus are getting BNPL data at scale, and most of these apps still don't send it. So the upside everyone's been promised, responsible payers building credit, is mostly still sitting in a box. So if your 3-digit score isn't moving yet, where's the damage actually coming from? From a person. When you sit down to borrow real money, a car, a mortgage, an apartment, the underwriter doesn't just pull your score anymore. They pull your bank statements and read them like a true crime board. Red string and all, and every one of those little Pay in 4 debits is a pin on the wall. They add them up, count them as debt you're already carrying, and quietly decide you can afford less than your score says you can. The debt that was invisible to the machine is extremely visible to the human. There's a name for the moment that flips, and we call it the materialization. The phantom puts on a body and walks into your loan application, which means the same habit splits into 2 completely different futures, depending on how you run it. 2 people, same app, opposite endings. Alex keeps it to 1 plan at a time, pays every installment on the day it's due, and because that file started as a blank page, the first thing written on it is a clean, on-time record. Bella runs 5 plans across 4 apps, misses one payment in a month where the paycheck landed 2 days late, and now has a tangle of small balances and a late mark sitting on a file she forgot was being written. Same starting tap. The only variable that changed was the stack. And about Bella's 5, a $90 jacket, $240 boots, a $140 beauty haul, a $300 gadget, a $180 treat. 5 purchases, $950 in total, sliced into payments so small each one feels like nothing, which is exactly the point. On paper, Bella has no debt. In her checking account, she has a row of withdrawals stacked across 2 weeks, and a coin flip's chance of fumbling one. But the person this really catches isn't Bella. It's Jake, who doesn't think of himself as someone with a debt problem at all. Jake brings home $3,840 a month. Watch where it goes. Rent takes $1,450. The car payment and insurance, $610. Groceries and gas, $720. Utilities, phone, the streaming stack, $290. He's got $770 left, and that already feels tight. Now the part Jake never wrote down. A pay-in-4 on a $412 car repair, another on $180 of kids' shoes, a third on a $260 appliance that broke at the worst possible time. None of it felt like borrowing. It felt like handling it. Add the installments, and there goes another $310 a month he never budgeted. We're at $460 left for everything unplanned, every field trip, every bad week. Then comes the month the paycheck lands 2 days late. 3 of those auto debits fire on the same Tuesday into an account that can't cover all 3. 2 bounce. That's 2 late fees, $9.99 apiece. Small, almost insulting, except they're the cheapest part. Because the next morning, Jake walks into the bank to finance a used car, and the bank manager doesn't even look up. He scrolls Jake's checking account, sees the pay-in-4 debits stacked across the month, folds everyone into Jake's debt to income, and the loan comes back smaller and at a worse rate. Jake's credit score never moved a single point. Check the math yourself. We'll wait. The score's fine, and the loan still got worse. Jake isn't reckless. 47% of people doing exactly this paid late last year. Jake just landed on the wrong side of the coin flip, and the system charged him for it without ever touching his score. FICO built a whole new number to measure this, and then left it in the box like a Peloton in January. The bank manager didn't need it. He had Jake's bank statement. You might be 3 steps ahead of us thinking, hang on, this could actually help me. And you're not wrong. The strong version of that argument is real. FICO ran a study with a firm on more than 500,000 people who took out a new pay-in-4 loan. More than 85% saw their score move less than 10 points. About what opening any new account does, and the ones with 5 or more of these loans, all paid on time, mostly saw their scores hold steady or climb. Pay-in-4 really is interest-free when you pay on schedule. Try saying that about a credit card, where the average rate now sits at 21.52% on the balances people actually carry. And first-time borrowers with thin or rough credit repaid their pay-in-4 loans about 96% of the time. If you have no credit history at all, an on-time record landing on your file is a real door opening. So let's concede it cleanly. If you run one plan at a time, pay on the day it's due, and never stack, this can build a thin file, and 0% beats 21% every day of the week. But that study's happy ending describes people paying on time. It does not describe the stack, and the stack is the norm. 63% juggle more than one, a quarter run 3 or more, and 47% paid late. The win is real and rare. The loss is ordinary. Worse, the upside is on a delay. The FICO score that rewards you is barely turned on, while the downside, that bank manager reading your statement, is fully operational today. The benefit is a forward promise. The cost has already moved in. So here's the rule you can use. If you're applying for a car loan, a mortgage, or an apartment in the next 6 months, open no new plans, clear the ones you have, and tell the lender about any that are left. They're going to find them anyway. If you're not borrowing soon and you genuinely pay on time, one plan at a time, never a stack. The danger was never the loan. It was always the stack. The fix, then, isn't to swear off these apps forever and feel superior about it. The fix is to refuse to let any of it stay invisible. That's the whole game. And there are 4 rules, simple enough to use tonight. Rule 1, one plan at a time, just one. Not because a second plan is evil, but because the stack is the thing that breaks people. Every late mark in this story came from more plans than the person could track. A single plan, you can see coming. 5 plans see you coming. So you cap it at one open plan, and you don't tap pay-in-4 on number 2 until number 1 is paid off and gone. Rule 2, drag the due dates into the daylight. The reason pay-in-4 works on you is that the payments hide. Small, bi-weekly, Pulled on a date you didn't choose, so you choose. The minute you open a plan, you write every payment date down where you actually look, next to rent, not buried in an email. A debt you can see on a calendar is a debt you can plan around. A debt you can't see is a tripwire. Rule 3, and this is the one that protects what matters, the 6-month rule. If a car loan, a mortgage, or an apartment application is anywhere on your horizon in the next 6 months, you stop opening new plans now, you pay off what's open, and you walk into that office with a clean statement. Because we just watched what happens when you don't. The score stays fine, and the loan still gets worse. You don't fix that in the room. You fix it in the 6 months before the room. Rule 4, the buy it anyway test. Before you split anything into 4, ask one question. Would you buy this today if you had to pay the whole price right now? If yes, fine. The plan is just a tool. If you're only saying yes because it's sliced into 4, that's not affordability. That's the slice talking you into it. And it talks a lot. Most people who use these apps admit they end up spending more than they meant to. Pay in 4 is a free sample that signs you up for a subscription you can't see. The Buy It Anyway test cancels the subscription before it starts. Watch Alex run all 4. One plan on the $130 thing Alex would have bought regardless. Payment dates written next to rent. No new plan until that one's closed. Nothing tapped just because it was split. 6 months of that on a file that started as a blank page, and the first lines written there are clean and on time. When Alex finally needs to borrow for something real, the phantom isn't a liability sitting on the statement. It's a quiet, boring, on-time history that helps. Same app Bella used. Same app that caught Jake. Opposite ending because Alex never let it go invisible. That's the shift, and it's an identity, not a budget trick. You stop being the person these apps quietly keep score on, and you become the person who keeps their own score. You don't beat phantom debt by hating the apps. You beat it by making sure nothing about your money stays a ghost. One plan, one calendar, eyes open. The people who come out of this ahead aren't the ones with the most willpower at the checkout. They're the ones who decided invisible was the actual threat and dragged every dollar into the light. So go back to that Thursday night, 9:48, your thumb over the button. $0 due today. Here's what's true now when you tap it. That 0 isn't free, and for the first time in the history of these apps, it isn't a secret. It's the first line on a record. And that record, not your good intentions, is what a lender reads when you ask for the car, the apartment, the rate. 47% of the people tapping that same button paid late last year. The button doesn't care which half you're in, but the record does now. If you know someone juggling 4 of these right now, and you do, send them this before their next pay in 4, not after. Subscribe if you'd rather see the trap before you're standing in it. For years, the debt watched you and said nothing. Now it talks. Make sure it has something good to say,